Good afternoon. This is Karen Sanchez. I'm here with Joy Deuce from our HR consulting group. Thanks everyone for joining us. We've got a pretty large group here today attending, so with it being a new topic, I think there's a lot of interest in learning about what the new reporting requirements mean for everyone, as well as making sure that we have a plan of action to ensure that employers will be able to satisfy those filing requirements. A couple of housekeeping items before we get started. For those of you who need CPE, there will be a couple of codes throughout the presentation. There's 3 different codes. You'll need to include those on a survey form that will appear at the end of the presentation, so be sure to write those down as we go through the process. We will be go ahead and type your questions in as we go throughout the presentation. We may not be able to get to all of them today, but we'll respond, and our team will send out some answers after the webinar if we're not able to address them as we go through. We just want to make sure we can get through all the materials in the time that we have here today. So we'll go ahead and get started. Basically what we wanted to cover today is to give you an overview of the Affordable Care Act reporting requirements. Many of you may be somewhat familiar with those, some of you may not have seen anything on it yet, so we're going to give you kind of a base level overview of some of those items. And I also wanted to do a brief reminder of some of the other changes that have occurred regarding what I refer to as the employer payment arrangements, some of the changes the IRS has made regarding arrangements for health care that are no longer permitted to be done on a tax-free basis. And then we want to focus on what employers should be doing as you walk out of the webinar, kind of what your to-do list is for the next steps.
Generally speaking, when you're looking at your employee headcount, an employer really does not have any true reporting requirements if you have under 50 FTEs, so full-time equivalent employees in its controlled group. So today we're really focusing on those individuals that employ 50 or more FTE or full-time equivalent employees. There are some things for those individuals that are under 50, but today's presentation will really focus on that. And we will talk a little bit later about how you actually calculate and determine what your 50 FTE is. So what do we know today? Healthcare reform is here to stay. So those who have taken the I'm going to shove my head in the sand approach probably want to reevaluate that and see if there's a different approach that would be better. It's very confusing. There's constantly new updates coming up and new guidance, but there are still many unknowns. The 2014 forms have been released and finalized. The 2015 forms have not been released and formalized yet. And really the big thing that we're pushing home with the clients is there is a heavy administrative burden that comes along with this process. Nothing that the government or the IRS institutes is ever easy. So we want to try to help you work through that and educate you to minimize that burden.
So I always, whenever any project's placed in front of me, I always want to know, why do I have to do it? Or what is the purpose of the form? So I wanted to start off with giving you an overview of some of the objectives that will be satisfied for these different reporting forms. And I think this helps me at least understand the nature of the questions that are being asked and what the IRS is going to use this data for. So it really covers 3 different broad categories. Many of you may be aware that there's an individual mandate requirement that came out in 2014. When you filed your individual tax return for 2014, you may have noticed there was a box on the form that you marked to indicate that you had health insurance coverage for the entire year. For 2014, the IRS trusted you that you were answering that question honestly. For 2015 and future years, they're going to verify that that information is correct, and they're not necessarily going to rely on self-reporting. So some of this information is for the IRS to make sure that they can tell that every individual who needs to have health insurance coverage has met that requirement, or is paying the penalty associated with that. Another requirement is the employer mandate. You may also be familiar that certain employers were required to provide a certain minimum essential level level of coverage at an affordable rate or be subject to penalties. These forms will prove on a month-by-month basis whether or not employers satisfy that requirement, or if the IRS should assess a penalty to the employers. And then the third one is that certain individuals can now obtain coverage through some of the exchanges, and depending on their income level, they may be eligible for a subsidy. Individuals, when they log on to the exchanges, they self-report certain information regarding whether or not they have coverage available to them, their income levels, etc. And in the past, the IRS accepted that self-reporting information. Now they're going to have a way to cross-check these employees' answers regarding the tax credits or subsidies that they received on the exchanges. I wanted to include a few definitions here. Affordable Care Act is like learning a whole new language as you start getting into some of the terms that are used in here. So I wanted to kind of give you an overview, or sometimes this might just be a helpful cheat sheet to go back later as you go through the process. So one of the terms that's used frequently is affordable cost coverage. This is deemed to be the lowest cost self-only health plan charge that you have, and this should have been 9.5% or less of the full-time employee's household income in order to be considered affordable. The IRS did recognize that as an employer, you're not likely going to know what your employee's household income is. You don't know what their spouse's income is, etc. So the IRS came out with a number of safe harbors that you likely took into account when you were determining your pricing for what you were going to charge employees, what coverages you were going to offer, etc. So there's 3 different safe harbors that you may have used in order to satisfy that. It's basically their 9.5% of their W-2 wages, 9.5% of a certain rate of monthly wages, or perhaps using the federal poverty line. And these codes will come into play later to document that in your filing.
We've just had a couple of questions pop up regarding if we will be sending out the PowerPoint presentation. We will be sending it out to all participants afterwards, so don't worry if you missed anything, you will have full access to it.
Okay, thanks, Trey. A few additional definitions. Minimum essential coverage is that the employer provided healthcare coverage that meets certain levels. You have to pay a certain percentage of hospital stays, doctor visits, things like that. Typically, those criteria were evaluated when you established your health insurance policy, and most of the brokers, insurance companies wrote them in a way to make sure that they satisfy those rules. This will be another question they'll ask you to represent on the form, that you did in fact provide these certain levels of coverage. And the minimum value coverage is that you're covering at least a certain percentage of the actuarially determined value that the IRS came up with. So the plans can't be so stripped out that while you might provide these benefits, they're providing such a low level that the IRS doesn't view that as meeting a certain minimum value. Again, most of these were determined when your policies were established, and either your broker should be able to assist you with that, or Helping Human Services has a calculator on their website as well that will help you determine if you satisfied that value as well. So along with this, I'd mentioned one of the issues was the employer mandate penalty. And essentially in 2015, if an employer has more than 100 FTEs in capital letters, which is a new term of full-time equivalents, which is a combination between full-time employees and taking your part-time employees and translating that into an equivalency. So we'll have some examples of that later. But if an employer has 100 or more FTEs, you could have penalties if you don't meet the following conditions. You have to offer minimum value insurance to up to 70% of your full-time employees. That'll increase to 95% in 2016. Throughout this process, you'll notice that there's a number of transition rules that the IRS put in place to try to make this easier for employers to administer. I don't know that it's going to be that easy, but there are some transition rules, such as the 70% later moving to 95%. In addition, the insurance has to be considered affordable, and it must meet the minimum coverage requirements. And so there's different excise taxes if you don't meet both parts of that test. I refer to one of them as penalty number 1. So if the employer fails to offer the minimum value coverage, and you have one employee who actually goes to receives a subsidy either through a tax credit or a cost-sharing reduction through an exchange, then the employer may be liable for a penalty of $2,000 per year for the number of full-time employees. And again, there's some cushion here where the first group of employees won't be subject to the penalty. So the first 80 for 2015 won't be subject to the penalty, and then that'll move to 30 for the following year. So the key issue here is that you have to offer benefits that meet these criteria. It doesn't matter if the employee decides not to accept the coverage. You can't force that. It's just one of the codes that will answer is going to be what did you actually offer to the participant. And then in addition, coverage for the dependent children, also has to be offered. So there's going to be some codes that will enter into the form that will help inform the IRS that you did in fact make appropriate offers to certain groups of employees. The second penalty is that if the employer fails to offer affordable minimum value coverage to at least the 70% of your employees, then the employer could be liable for a penalty of $3,000 per year for each full-time employee who obtained insurance through an exchange and also received a subsidy. And the employer is only liable for the greater of the two penalties. And these penalties are determined on a monthly basis. So this becomes relevant when you look at the nature of the information the IRS is requesting. They're going to be looking for employee counts on a month-by-month basis, along with inquiries whether or not you satisfied some of these requirements. Just as a refresher, for individuals who do receive a subsidy, employees go online to an exchange potentially, and they inform the IRS of what their family income is, and they also provide who they're working for. Or employee could claim a tax credit on their Form 1040. And the IRS receives all these data in from the tax exchange, or from the exchanges and the tax form, and then they're going to send the employer an excise tax bill, likely several years from now, where they're kind of predicting in 2018 employers may be receiving that bill, and employers will get about 2 months of time to respond to it. So this is where Joy's team has been working with a lot of clients to make sure that as we go through the process of all the information that's needed, that you're retaining sufficient records and documenting these things in a way in which will allow your teams to respond, in a very timely manner to these requests. It may not be you sitting in your chair the day that the IRS sends the bill out. Someone else could be the lucky recipient of that invoice and not have a clue, where to be looking for information regarding 2015 when it could be years down the road. And the IRS right now with the 1099 reporting and the matching program, it takes them a couple years to send out inquiries about some of the information on those. And when we get to the forms, you'll see that these are much more involved, and it's a new process. So we're anticipating it's going to take a while before some of these assessments come out, and very likely there's going to be some errors in the process of how the IRS is assessing the penalties as well. So we're planning on being fairly busy in a couple of years when these notices start coming out. And of course, by the time the notice comes out, the employer may have most likely filed in the same manner, for several years after the fact, and those issues would continue on into future years. So this will be interesting how all of this falls out later. Joy mentioned earlier who needs to file or what these reporting requirements are going to be applicable to. Another new word for the day is applicable large employer, or ALE. This is what the IRS has defined to be the group of folks who are lucky enough to get to file under these new rules. So an applicable large employer is an organization which includes related entities that employed on average at least 50 FTEs, which includes your full-time equivalent employees, on business days during the preceding calendar year. So it's a look-back calculation. So you're going to go back into 2014 to figure out what your average full-time employee count was, looking at a specific period of time. We'll have an example here in a couple moments. There are, again, some transitional rules here that for 2015, you can go back into 2014, and rather than look at all 12 months and determining your average based on that, you can pick any consecutive 6-month period. So you can try to play around with the numbers if you're on that borderline of needing to report of the 50 employees and see whether or not you can be exempt from that for that period of time. Once you do that calculation, if you've got at least the 50 FTEs, you're going to have to file for 2015. We're using kind of a general rule of thumb that if you look at your 2014 W-2s and you see that you issued at least 50 in 2014, at a minimum you should go through this calculation to determine whether or not you're going to be defined to be an applicable large employer for 2015.
And if you determine that you are under 50 FTEs, technically you don't have to go through these reporting requirements, but there are some things to keep on the horizon. The Cadillac tax, which will be kicking in 2018, will be the next large landmark that comes up. Also, we've seen a lot of employers that have under 50 employees that have some unique health insurance arrangements, perhaps for their owners, their top executives, or their plans aren't compliant with the original requirements of the Affordable Care Act. So we are encouraging them to work with their broker to make sure that their plan is compliant. So if you're under 50, you get a pass from this, but the key, as Karen said, is really to determine that you truly are under 50 FTEs.
Yeah, there is, if you are under 50 and you're self-insured, there is still a 1094B form that those employers will need to file relative to that information, but other than that, under 50 gets a pass on these rules for, at least for the time being. A couple other issues to consider when you're going through applicable large employer status determination. Seasonal workers have some exclusions that can be considered during this period of time that may help you stay under the threshold, that perhaps it won't push you over that determination. Also, you know, in terms of, I mentioned related employers need to be considered. I listed some of the tax codes here that are going to be considered. So basically you would look at the control group rules and the affiliated service group rules that you may be familiar with, because you likely needed to take a look at those for your health insurance coverage rules. And the not-for-profits are using some of the control factors that you, again, likely took a look at with respect to your health insurance coverage. So you need to take a look at all related entities to determine whether or not you're subject to these rules. We've had a lot of creative clients trying to come up with ways to avoid this of, I'm going to split my organization into multiple units and they all happen to be under 50, and then I'm not going to have to do this or be subject to the penalties as well. To the extent that you retain control under and are considered a related employer under all these rules, breaking your company up into multiple entities isn't going to help you avoid the rules. When we take a look at the forms, they're going to ask you what related entities you have on the forms, and you have to kind of cross-reference other entities in the filing to make sure that, again, the IRS is not really trusting taxpayers that they're going to automatically file these appropriately. They're making you indicate that you do, in fact, not need to file.
And we're going to talk a little bit further about how independent contractors, seasonal employees, interns affect this a little bit later in the presentation. One question that we have been receiving regularly is, well, if our workforce is unionized, are we exempt from this? Unionization has no correlation to the Affordable Care Act. The union is not liable to complete these forms or complete this process. That is completely unrelated to the Affordable Care Act. So regardless of unionization status, the employer is still liable for completing the requirements.
Thanks, Joy. That's a good point. Lots of details. With anything new that comes out with the IRS, there's tons of details and tons of exceptions. So we're giving you kind of a high-level view of many things here today. So since I'm an accountant, we have to give you a number example of how to go through the calculation that we've been talking about in the determination. And then for those of you who are visual, we'll have a picture on the next slide. So to determine how to calculate the number of FTEs per month, you take the number of FTEs that you have, those that work 30 plus hours a week. You add the total hours of service by all your part-time folks, and you divide those by 120, and that's the number of FTEs you have for the month. Then you do the average by month for the year. And I mentioned again this transition rule where you could take a look at a 6-month period versus a 12-month period. And at the end of the day, if the answer to your number at the bottom is more than 50, then you're going to be an applicable large employer for the following year. So you'll want to do this calculation for those of you who are on the border line of knowing whether or not you have 50 in order to make that determination. We did give you a website link here too that you can type in this information. It'll help you do that calculation, or I gave you kind of what I put into a quick spreadsheet here that illustrates what we just talked about, where for each month you're going to add up the total number of hours of service for your part-time employees, and then there's that 120 factor that you would divide into that. Then you come up with the FTE value of your part-time employees, you add that to your full-time, and then the total column gives you that FTE number for the month, and I just averaged those up, and in my example I had 61.84, so that's greater than the 50 count, and so this employer would need to file for the following plan year. So step one for everybody out there is to figure out whether or not you're subject to the reporting requirements. Clearly, if you are filing a couple hundred W-2s, you're going to be subject to it likely. But for those of you who are on the board, this will be your first homework assignment to determine that. Once you know if you are subject to the reporting requirement, you have to figure out what forms you have to file. The first two listed here, the 1095-C and the 1094-C, is what most of you as employers are going to need to provide. The 1095-C is the form that goes to each employee, and the 1094-C is sort of the cover sheet or the transmittal. For those of you who filed 1099s, there's a 1096 transmittal form. W-2s, you have a W-3 transmittal form, so this is the pairing that you have for these new forms. And then the insurance companies will be doing the 1095-B and the 1094-B series of reporting as well. There is some more transition relief available. Early in February, they indicated that employers with 50 to 99 FTEs are not subject to the penalty requirement, but they did not release you from your obligation to file the forms. You still have to file the forms, but if you didn't satisfy some of the coverage rules or the minimum values, or you missed some employees, you get a pass on the employer penalties that we talked about for 2015. Employers with 100 FTEs, you're all in the game this year. You're going to could be subject to the penalties, etc. Unfortunately, we are not seeing any signs of any delays in filing the forms as well. The 2014 forms were issued in February of 2015, so although the 2015 forms are not out yet, we do believe that they're going to be fairly unchanged from what was issued in 2014. So this is just a visual on what forms you'd need to file. Small employers, those with less than 50 FTEs, the insurance company will take care of issuing the 1095-B to your employees. But if you're self-insured, you're going to need to file the 1095-B form relative to that coverage. The middle category is your 50 to 99 FTEs. Really that and the 100 or more filing requirements are the same. The only difference between these two is indicating that transition period for 2015 for the smaller group. So if you have a fully insured plan, Blue Cross, Blue Shield, whoever does all your benefits, you as an employer are going to be responsible for the 1095-C and the 1094-C. If you're self-insured, then you're going to get to do another section on that form that we'll talk about. And then the insurance company, if you're fully insured, will take care of doing a 1095-B. This should hopefully be a little clearer when we look at a couple of the next slides. So our first CPE code is the word filing. Pretty creative given the topic that we're going over, I know, but make sure you jot down that note, include that in the survey at the end. We're doing both CPE for both CPA purposes as well as HR organization credits as well. Okay, so what does the employee receive when these forms are filed? The employer is going to prepare Form 1095-C for each employee who was a full-time during 1 or more months of the year, and for each part-time employee who was enrolled in coverage during 1 or more months of the year. If you have a fully insured plan, then the insurance company is also going to issue a Form 1095-B to the employee. Your employees will actually get 2 different forms that they'll get to take to their accountant in early 2016 and say, I don't have a clue what to do with this, what do I do with this? we are going to be offering a filing service for our clients to assist with this whole process, and one of the nice features that we have in that software is you can actually put either a custom sheet for your employee or some notations on the form with some messaging surrounding what it is that they're going to get. Because the last thing I'm guessing your HR departments want early next year is they get all the W-2s sent out. They're already getting a lot of questions on the W-2s, but now there's this whole new filing that someone on your team is going to be the lucky recipient to get those phone calls on. So hopefully whatever service you're using, you'll have the ability to put some messaging in with the forms to give them some direction as to what the purpose is for them and who they should reach out to for additional questions.
And just to be clear, individuals are not going to be able to file their personal tax returns if they do not have this form. It's similar to not having a W-2. And therefore, if you're not keeping up on it and sending them timely, there could be some issues. As a side note, Karen had mentioned who is responsible. We get a ton of questions as to who is responsible within the organization for Affordable Care Act. Is it the accounting department? Is it payroll? Is it human resources? It's kind of like the hot potato game. Nobody wants it. The answer is very gray. It really depends on your organization. We have seen some ownership within payroll. We have seen some ownership within HR. We have seen some ownership with the CFO, the management level. So really the key is to determine who is the owner, who makes sense based on the data that you have to provide in order to execute that.
Thanks, Joy. So the IRS will also receive some information as a part of the process. So the employer will file that 1094-C transmittal form, and as well as copies of each employee's form 1095-C. And then the insurance company is going to file with the IRS for those fully insured plans, the 1094-B transmittal form, and then the 1095-B copies of each employee's form. So the IRS is going to have all that information available. You have the option to electronically file if you have less than 250 employees. We're strongly encouraging that everybody electronically file. When you take a look at the forms that we have here, I would be very surprised if the IRS gets the data entry correct when you take a look at the different coding that's in there. And miscoding could result in some of the penalty notices that are out there, as well as, if a box is left blank, it could mean that penalties need to be assessed, etc. So we'll talk about some of that in a bit. Here's the copy of the 1095-C. I apologize, it's a little bit small, but wanted to give you kind of a high-level view of the form itself. Again, this is the 2014 form because the 15 has not been released. Part 1 is pretty straightforward. We're going to list each employee's name, address, social security number. That should be easy. You obviously have that for all their W-2s. And then to the right is the employer information. Again, that should be fairly straightforward. One thing to note is that there is an employer contact name and phone number information on here. So if each company, as Joy said, you have to decide who's going to be the contact person for employees to reach out to with questions on this. The middle section of the form is some of these offer and coverage codes that I mentioned earlier. 3 different boxes. Again, they're by month need to be reported, or if they're the same for all 12 months, then you can just use the first column on the left-hand side. Line 14 is your offer of coverage. Again, this is just what did you offer to employees. Doesn't matter what they took. What did you offer to the group of employees that they're a part of. Line 15 is what was the lowest share of, or what's the lowest cost to the employee for self-only coverage. Again, not what they took, but this is to make sure you satisfied the employee affordable coverage rules. And then line 16 is what did the employee actually take. Okay, and then part 3 of the form is the who all was covered by the plan. If you're self-insured, you need to complete the information on which individuals are covered under the program, again, by month of the year. If you're fully insured, the insurance company is going to do this information for you. If you're self-insured, you need to complete this information as well. So this is just kind of a summary of what we just went over. Here's the listing of the codes. I don't expect you to to learn through all of them today, but line 14, here's the different codes that are going to be offered. These are just right from the instructions for the forms. Again, you're going to pick the code that's applicable for each month during the year. Line 16, this is the codes. What did the employee actually do? You would indicate whether or not they weren't employed for that month, if they were in a waiting period for the month, if they didn't take coverage, how you deem that you satisfied a safe harbor and aren't subject to the penalties. Oftentimes you might use code C because they enrolled in coverage and maybe they were enrolled for the whole year. So you're going to have some folks that are easy to code, and then others could have multiple different codes if they were new and terminated in the same year. You're going to have a variety of different codes to put in for them. And again, if you're self-insured, you're going to need to have the name of every spouse and dependent as well as a Social Security number. If you don't have the Social Security number, you're required to at least go through a process to try to gather that, or you can use the date of birth, but you have to have at least gone through a certain process to attempt to obtain that information, so you'll want to be gathering this information. Here's the transmittal form, the 1094C. Most of the top information is pretty straightforward. Again, the IRS wants a contact person. You reference if there's another related entity covering some additional safe harbor options that might be available there. Here's page 2 of the 1094C. Unlike other transmittals, this one has multiple pages to it. You have to indicate by month whether or not you met the minimum essential coverage, your full-time employees by month, your total employee count, and then there's some other coding for some transition relief and control groups. So here's a little bit different information on, or additional information on those line items. Column A is basically, you know, if you enter yes to that, you're telling the IRS you're not subject to that penalty number 1 for the $2,000 excise tax for that particular month. I've given you a little bit more detail here on what some of these counts mean. Column B for your FTEs. If you satisfy one of these other safe harbors of this offer method, then you might not have to complete this column. Column C, determining your total number of employees. You get to choose how you're going to count your employees for the month, but you have to be consistent. So we listed some of the different options here. I think this is similar to how you may be doing this for 941 purposes, but you will have to be providing that information as well throughout the year. With everything the IRS does, there's penalties to comply, or for failure to comply. So it's $100 for each delinquent or incorrect return for the individual side as well as on the employer side. So they do cap them at $1.5 million. So I guess that's one benefit that we have. So you couldn't owe more than $3 million, you know, for penalties for not filing the forms. You could obviously owe more than that on the employer mandate penalties. The IRS has indicated that, you know, they may waive some of these penalties if you can demonstrate that you had a good faith effort to comply. But, you know, putting your head in the sand, as Joy mentioned earlier, probably isn't going to be a real good way to get some penalties abated for the current year. You have to give us a little bit more to work with on our forgive me letters than that.
And I know we went through the forms rather quickly. We only have an hour together today, and we had a very aggressive agenda. We could spend days on this, and I think really once you get through the process of understanding what your needs are, the forms will make a lot more sense as to the information that you have to comply with.
So timing of the reporting, think about it as just the same as your W-2 reporting. So the employer reportings due the end of February. And if you electronically file, you can get until the end of March. And again, I would encourage everyone to electronically file regardless of size. But the employee reporting is due, again, the same as the W-2 timing. So this year it'll be February 1st, 2016 due to the timing of the filing. So not a lot of time to be gathering this at the end of the year for this data by month. So we're really encouraging employers to be working on this really throughout the summer months, making sure they have a software filing solution and have a plan and are gathering data for the first few months of the year and have tested that out to make sure that, you know, come January we don't find out that the system blows up, doesn't work, or you're missing some key data. Again, the electronic filing, you only have to do it if you have more than 250 returns, consistent with some of the other electronic filing requirements. However, really would encourage everyone to do that. Employee copies, you technically can do those electronically for them, but you have to get their consent as well. So I think most folks are going to be sending these out in paper form at least this first year, rather than trying to get employees' consent for that process. So we have a filing solution that can help go through that process for you as well.
So this chart kind of exemplifies what we were talking about earlier, that you within your organization have to determine who is going to own this process. And it might be payroll, it might be HR. One of the things that I generally hear from clients is, oh, my insurance broker's taking care of that, or I'm with ABC payroll company. I would reach out to those individuals immediately. I had a client that was with a large payroll vendor, and they were under the impression that they were going to be providing this service. However, there were certain modules that you had to have. You had to have their time and billing, you had to have their HRIS, and you had to have their payroll in order for them to provide that to you, which unfortunately our client did not use their time and billing. So if you are banking on having your payroll provider, your insurance broker, take care of that, I encourage you to reach out to those connections immediately to really determine if they can meet your needs, and if not, is there a certain upgrade or another option you need to look at. The last thing we want is people to end up the end of December finding out that the service they thought they were going to be getting from their existing vendors is there. From the payroll perspective, as I mentioned, each system varies, and you really need to understand what the capabilities are and what is being provided to you. There are significant administrative burdens, so please, if you make one phone call today, make it to those providers that you're banking on that are going to assist you with this, so you understand the true responsibility there.
Yeah, we've heard that some of them are offering maybe a file that will need to be imported into another filing solution. That you want to make sure that ultimately they're actually going to prepare the 1095-C form for you, as well as offer a filing solution, just to ensure that you know exactly they're going to take you from an end-to-end solution for your filing requirements.
So some of the questions that we've been hearing, the first thing to really determine is if you're a large or a small employer. And again, a large employer is 50 or more full-time equivalents. So as Karen previously mentioned, a good starting place is how many W-2s did we issue last year? Then based on that, you need to take a look and see how different people entering and exiting your business can affect that. So seasonal employees. Maybe you hire interns for the summer, you have college students that come in, you have some apprentice individuals that were working for you. You need to go through a very detailed process of establishing a measurement period in which you're going to assess those hours. The great thing is the employers get to choose the measurement period, which is a plus, and therefore we're encouraging employers, if you have an excess of individuals working through in the summer and you're kind of teetering on that 50 employee mark, maybe you shouldn't choose the summer as your measurement period. Once you establish the measurement period and you look through that, then you have to look back at the stability period. And there are a number of different regulations. The stability period can't be longer than the measurement period, and so on and so forth. And so if there is an opportunity there where you need to look at how individuals flow into this process, we're happy to help you through that FTE equivalency. And again, this is really for those people who some parts of the year they're 40 employees, some parts of the year they're 60 employees. If you are issuing 200 W-2s, you don't even need to go through this exercise because chances are you're a large employer. So what you really need to think about is if you're on that teetering point, what is going to be your measurement period? What is your stability period? How are you tracking the hours of those part-time or variable employee type employees? So your interns. Another huge thing that plays into this, and another phone call you might want to make today, is temporary employees. So you utilize a temporary service to provide you employees to come in and work. There has been a lot of different discrepancies where the temp agency believes that you are owning that employee, and you as the employer believe the temporary agency is owning that employer. So we are encouraging you to reach out if you have those type of arrangements, and number one, find out if the temp agency is going to include those individuals in their reporting, and if so, we're highly recommending that you get that in writing. So you update your contract with them to demonstrate that they are taking ownership. We are seeing where temporary agencies are not taking ownership, or excuse me, are taking ownership. Some of them are instituting a surcharge for that. So because we're taking accountability for this person, we're offering them the benefits. You're going to pay an extra $2 per hour on top of what you're already paying. But the big takeaway is make sure that you have a very clear relationship with those agencies and that you have it documented who has ownership for that employee under the Affordable Care Act.
So our next CPE code is healthcare, another creative code for you, so please jot that down for the survey at the end. On the employer payment arrangements, this doesn't necessarily relate to the Affordable Care Act reporting, but I just wanted to remind folks that this is out here real briefly. In a notice in 2013, the IRS came out and gave some additional notice on how they interpret the definition of certain group health plans. And basically what they said was that in the past there's been employers doing a number of different reimbursement methods for their employees. You might have different situations where this employee doesn't need to be on our policy, so we're going to give them a different special kind of a reimbursement arrangement. We see this mostly in some small employers, many who don't have group health plans, and so they've created a number of different reimbursement arrangements for their employees to provide some benefits, but not necessarily sponsoring the full program. Essentially what the IRS did was they said that payments for health insurance outside of these group health plans, they're generally not going to be permissible any longer because the IRS came out with this definition of group health plans needed to satisfy certain requirements that, no lifetime limits on certain benefits, etc. And by definition, all these different reimbursement arrangements that exist really can't satisfy those different definitions. So there were situations where employers were reimbursing employee premiums for individual policies on a tax-free basis. And those types of arrangements just are not going to be permitted any longer. The IRS came out in 2015 with some additional guidance on that and gave us some transition rules to allow employers to eliminate these arrangements because the IRS basically said there's in addition to the need to not just tax employees on these benefits, but there could be excise tax penalties associated with it as well. So this just relates to health insurance coverage, not dental or vision. I did put some slides in here. The slides, you can download later and take a look at them. We won't go through all this part today, but just a refresher to take a look at anything that you're paying for medical expenses under different arrangements to make sure that you're satisfying the current IRS rules. Your employer group plans, insurance premiums paid by the employer under group health plan continue to be excludable from pay. Employee contributions are tax-free as long as you have a Section 125 plan in writing that allows for those, so there was no impact on those arrangements.
So Karen and I can see the questions coming up, and apparently there were a number of people who missed the second keyword, and they were told we can't provide it again, and I love the person who said, but I am listening, I promise. So we can see actually if you're listening or not, little trick there. So I'm going to give you a favor, and I'm sorry to our individual, but the second keyword was healthcare.
You have some really good reasons for
I love why everybody missed the keyword, by the way. If I could share these reasons, it would make for a very entertaining webinar.
Back to our lack of entertaining webinar here. So for those of you who have health reimbursement arrangements, that's where you as the employer are making contributions to subsidize, say, up to their deductible amount. Those would continue to be excludable from income as long as you've integrated that with a group health plan. In other words, you actually have a group health plan. If you don't have one, these types of arrangements would work going forward. And other types of just employer payment plans, if you're just making use kind of the accountable plan rules and you reimburse employees for certain medical expenses under a policy, Again, those wouldn't work for individual insurance premiums any longer. And then your health flexible spending accounts, again, as long as you have a group health plan, the flexible spending arrangements under those would remain okay, as long as, again, you have a group health plan. For those of you who offered individual insurance premium reimbursements in those, we need to get those provisions removed from the plans. So basically, again, just take a look at how you're paying for any medical expenses. If they're outside of your group health plan, it may be worthwhile to investigate that to make sure you don't have any other items that need to be kind of cleaned up there. So what do you need to do at this point in time? I know we've thrown a number of things out there, and I know the first time I looked at these, it was pretty much overwhelming to take a look at the form and everything that needs to be done. So I think the first thing was figuring out if you're subject to this or not. Likely all of you on the call are likely subject to it, or you wouldn't be spending your lunch hour with us going through the process. So you're determining which forms you need to file. And again, if you have that more than the 50 FTEs per month, it's time to figure out where you're going to get the data from. Find out from each of your vendor what they're going to provide. I saw a form from Blue Cross Blue Shield the other day in their newsletter where they said, as a reminder, for fully insured plans, we're not required to provide you any information. For those plans, they will do the 1095B, but it's up to the employer in order to get the data that needs to be issued out there. Different payroll companies are offering different levels of service depending on which platform you're on. It's continually evolving every day. What one company said they weren't going to do, they're coming out with arrangements to partner with somebody to be able to provide that. Some are saying they're promising to develop the software later in the year. So it's certainly an evolving area right now. So take a look at what options are available from the different vendors that you work with. Make sure, again, that they're going to actually prepare the form and file it for you. Not all of them seem to be offering that, but the sales presentations sound really good until you kind of dig through the details of that. So make sure you've got your software filing solution, that you're going to be ready to go. Given that this is new for most folks, you're not going to have a lot of those that have actually done it before. There are a couple out there that did do a number of the state exchanges last year. They're the back office for a number of the insurance companies, which is one of the ones we've chosen to use for our filing for our client needs. Anyway, you need to also take a look at those employer mandate penalties to see if you think you're going to be subject to any of them. And then, of course, when you prepare the forms, you want to make sure that they're coded to reflect that you don't owe any penalties. I think if you maybe even leave one of those boxes blank on the 1095-C, that opens you up to the IRS interpreting that they should assess a penalty for that month. You put a 00 in the box if there is no code to enter, but a blank could potentially mean that there's some penalties to be assessed.
And we're getting a lot of questions about specific examples. So if you have an HRA, if you're providing a stipend to people not to take your insurance, if you are reimbursing Medicare, those are somewhat specific. So just in the interest of time, we're going to address those afterwards.
If you do have an employee that just elects out of your coverage, you can still pay those amounts, in lieu of taking coverage. Those types of arrangements are still fine as long as you tax them on those payments. So again, you need to make sure you retain all your documentation relative to this. Again, this is a lot of information, and it may not be as fresh in your memory a couple years from now as it is today as you're working through that process. So determine how to save it in a way that it can be easily accessed and documentation can be obtained later. Again, take a look at those payment practices regarding health payments to make sure that you don't have anything outside the scope of the allowable rules. And the other one would be start early. The reality is we're actually about almost halfway through the year now, in the middle of June. 4th of July will be upon us quickly, and then we'll be in the second half of the year. Our goal with our clients is to be actually reviewing the information over the summer months. We can test information on an interim basis, make sure that all the process is there, we know where all the data is going to come from, and then we can do the rest of it in December, January, once we know all the final information comes in. You know, so because a lot of this could actually be prepared and be ready to go in December, as long as you're not hiring any other folks on late in the year, or they may not even become eligible for the benefits depending on your timing. So we'll have the process we can help you determine your filing requirements and any potential penalties, help you work out your documentation systems. Again, we'll be testing some of this data during the summer and the fall to make sure that it's ready to go, and we won't be spending your holiday months having nightmares about these filing requirements. Making sure you got the right documentation. Once the IRS starts sending notices, we'll be helping clients likely respond to those items. And then, you know, don't forget about it's time to plan. It'll be time to plan for 2016 as we go into the fall, and there might be other things you want to change within your workforce, you know, to avoid some of these requirements.
And from a client service perspective, you know, my team handling the HR aspects, so are you over 50, you know, those type of things. We have our tax team who's prepared to handle that. We have Karen, who's kind of the jack of all trades, but we really have all the different resources, so depending on what your need is, we're there to assist you with it.
So for 2016, many of you may already be looking at some of these items, but we've had a lot of clients, again, trying to avoid some of these requirements. But, you know, is there different ways that you can manage your workforce size to those that are eligible for the coverage? Obviously, health insurance continues to be a rising cost of having an employee on board. And so we've got, you know, some employers taking a look at, can we use more employees that are working less than the 30 hours? Obviously, you have to be careful about how you implement changes like that, and maybe it's determining who new individuals who you're hiring into your workforce versus, you know, changing hours of the individuals you have now. Do you want to take a look at using more contractors? Obviously, that has a whole set of rules associated with whether or not they actually qualify as contractors. You know, do you want to hire more seasonal employees rather than keeping them on long-term? All those different things obviously have a lot of different issues, but those are, you know, some of the different strategies folks are taking a look at to try to mitigate some of the health insurance rising costs that are out there. You know, eventually, you know, we may have more and more employers going on to exchanges. There's starting to be private exchanges created now that many of you probably are working or considering, you know, along with your broker. You know, do you still want to be in the health insurance game? Nobody wants to be the first one to jump out because you want to continue to be an employer of choice and make sure that you're able to hire, you know, the best talent out there. Also, you know, just taking a look at your welfare plan compliance, making sure that you're filing your 5500s. If you have more than 100 participants, just about every day, or not every day, but frequently you run into folks that have just crossed over that 100 participant mark and may not be aware that they need to file welfare plan filings. The IRS, or the DOL rather, is doing a matching program that says, hey, you have a retirement plan. I see you have more than 100 participants. Why wouldn't I see a welfare plan out there? So you want to make sure you're filing that, as well as making sure that you have a plan document in place for your welfare plan, which is not necessarily the same thing as the insurance company booklet that you get on your fully insured plans. There's different eligibility criteria, coverage things that may need to be documented in a plan document, as well as that really defines how you file these 5500s as well.
Just kind of to give a high-level overview, we can provide as little or as much assistance as you want. We have some clients who said, I really need as much help as possible because I have a very unique situation. We are partnering with a software provider. It's a Thomson Reuters product. They actually did a number of the past year's state exchange filings, so they've already been through this once. The minimum investment, if you were going to buy the software on your own, is about $13,000. Most of our clients can't afford that, don't want to afford that, and did not budget for that. So at the end of the session today, as part of your survey, we're going to be asking if you have interest in partnering with us on that, because we're really looking to bring that cost significantly down by you tacking onto our licenses and utilizing the software to file your information. And the software is pretty slick, and it has a real nice process of using Excel to download from your payroll system, or you manually entering in Excel and then uploading from there. So if that's something you're interested in learning more about, we'd be happy to help you with that.
Another item, just if this wasn't enough, just want to make sure that everybody remembers that the Cadillac tax is still scheduled to come into effect in 2018. There is a lot of discussion out there right now and proposals to modify these rules or repeal it entirely. The IRS released some guidance back in February this year, and it put a request for comments on a variety of items in terms of how this calculation should be done. But essentially, it could be a 40% excise tax on certain level of benefits, and a lot of the projections are that many employers' plans are going to be subject to this. I think this was intended to be a, you know, if you're going to provide really, really rich benefits, that the employers are going to pay a premium in the form of this excise tax penalty. But the reality is that I think many more employers are going to be subject to it than was originally intended. Another reason that we wanted to bring it up now is that for those of you who do have different union collective bargaining arrangements out there, depending on when your bargaining cycle is, if you're negotiating for benefits that may be applicable in 2018, you want to take a look at this, because the tax is going to be assessed on the employer level, not on the union, not under the contract. So you as an employer participating in a collective bargaining agreement or subject to a collective bargaining agreement, you know, it could be forced into the excise taxes and not really having any room to negotiate that.
And just we've had a number of just the same question come up, so I did want to clarify something that we had touched on before. Let's say, for example, you have employees and you say, if you do not take our insurance, we will give you $500 a month in lieu of taking our insurance. That is still acceptable to do as long as it's taxable. What we're not recommending, we had some employers who were paying for their insurance directly, paying their Medicare bills, paying their COBRA. You'd much prefer to do it as a stipend and tax it to keep that clean. And there are some other unique things that go around with that, but if you still have that type of arrangement, you still need to make sure you're offering them coverage under the Affordable Care Act. And then ultimately you can have that type of arrangement as long as it's taxable.
Well, the IRS is even concerned about the concept of a stipend because they're going to assess excise tax penalties on that likely. So we're really recommending that you just make some compensation adjustments and try not to tie it, you know,
directly to
any adjustment that's happening here, because you don't want to be perceived in any way that you're sponsoring a non-qualifying health plan under those arrangements. So. We did post some information on our website. We have an Affordable Care Act page. We have a guide you may have seen. We've got some FAQs from the IRS out there. We have been recording the webinar today, and it'll be posted on the website probably within a week of today's webinar. Will be available as well. We would be interested in any of your survey responses as well. Again, we're trying to determine the filing needs of our clients, how much workload we need to schedule for. We're hearing from a number of other vendors that they're going to be stop accepting, you know, new clients at a certain point in time, and I hope we won't have to do that as well. Again, our goal is to kind of determine our needs and make sure we can create enough capacity to assist everybody that needs our help through the rest of the year and into the filing season. But again, you need to essentially figure out what you have to file, who's going to do it, how you're going to do it, and make sure that that works as you go through the process. Our last CPE code is reporting. Again, another really creative name, I know, as we go through that process. Did want to just include our contact information here as well. I know we've worked individually with a lot of you, but for those of you who don't know us, either Joy or myself can assist as a frontline entryway for questions. Many of you may also want to just reach out to your Sikich tax client service representative. Our tax team is obviously involved in this process, and you're working with them regularly on a number of other you know, projects throughout the year. So we really just tried to create a whole team environment here that would include the benefit side, the HR side, the tax group, and our accounting service in the filing requirements. So it's going to be a giant group. I was going to use the word party, but I'm not sure party is the right way to describe what the next year will mean.
Just to confirm, we will be sending out the presentation afterwards to all of you, as well as a couple slides back from the end is the link to our website, which has a lot of information. On your survey, in order to get CPE or HRIC credit, please complete that. It will pop up immediately. In there, we are also gauging your interest. If you would like us to reach out to you to learn more about your needs, and if you're interested in engaging us for services, simply indicate that and we will reach out to you directly. We have some follow-up questions to better understand your needs and guide you through this process. At that point, we've hit 1 o'clock, so we do want to respect your time. If we did not get to your question today, we will be reaching out to you to answer that directly. And as Karen said, if you have any follow-up questions, our contact information is located on the last slide of the deck.
Thanks, everyone.
Have a wonderful day. Thank you.